Ray Dalio has earned widespread recognition for his book, Principles. The book covers how to identify what's important to you and optimize your life around those values to produce results. He's also a regular commentator on business news ranging from stalwarts like Bloomberg and CNBC to a recent appearance at CoinDesk's Consensus Conference, where he made waves when asked about his stance on crypto. Oh, and he also happens to run the world's largest hedge fund. Whether he's talking about the effect of monetary policy at the Consensus Bitcoin conference or writing about the history of reserve currencies on LinkedIn, Ray Dalio is clearly one of the smartest men in finance. The Capital Asset Pricing Model, or CAPM, is still taught in undergraduate finance courses today. Dalio saw a different way to approach risk and returns across all the different asset types. He uses a combination of diversification and leverage to achieve higher returns than a typical portfolio or index fund, with lower risk than more speculative asset classes like venture capital or emerging markets. If you optimize for risk, a backtest from 1970 to 2010 shows this diversified 10% leverage approach consistently beat the market. Or you can target a specific return at a much lower risk and a more predictable return. Predictable and stable returns at lower risk is music to wealthy investors' ears. This might be why Dalio's Bridgewater Associates became the world's largest hedge fund with $140 billion in assets under management. Ray Dalio keeps his leverage and hedges under wraps, but we can still look at which stocks his Bridgewater Associates was holding at the end of the first 3 months of 2021. SPY, the ubiquitous S&P 500 index fund, made up 10.97% of Dalio's portfolio. The S&P 500 has rallied to record-setting highs this past year. Historically, the majority of active money managers don't beat its annual returns over the long run on stock picking alone, and it's obviously diversified. Though SPY is more weighted towards tech giants, with Apple making up 6.1%, Microsoft 5.8%, Google Class A and C shares a combined 4.25%, Amazon 3.82%, and Facebook 2.32%. Even Warren Buffett recommends it to anyone who doesn't know stocks.
That's assuming we're all dead.
I recommend it. I recommend the S&P 500 index fund, and have for a long, long time to people.
Berkshire Hathaway is the largest non-tech stock, making up 1.44% of the ETF. Sign up for Portfolio Insider to see the full list of SPY component stocks. State Street manages SPY and charges a low fee of just 0.09%. The dividend yield of 1.31% is icing on the cake. Vanguard's VWO was Dalio's second most owned asset. The ETF contains a diversified list of international stocks picked by London-based finance newspaper, The Financial Times. The late John Bogle wrote, "Don't look for the needle in the haystack, just buy the haystack." The famous founder of Vanguard advocated for index funds. Well, finding a good manager is like finding a needle in a haystack, and everyone knows what that's about. Good old Don Quixote had it about right. And so it just makes common sense to own the whole market and not just a few stocks. You don't need to take a risk on an individual stock. Take the market risk, which is quite high enough. The largest holdings within VWO are Taiwan Semiconductor, making a combined 6.14% of the portfolio, Tencent at 5.18%, Alibaba at 4.63%, Meituan Yongping at 1.84%, and Reliance Industries at 1.04%. The Chinese Communist Party crackdown has not been kind to the share prices of Tencent, Alibaba, and Meituan, but some investors believe China's tech giants may be undervalued now. However, 3 things work in VWO's favor going forward. Dalio believes Asian countries will contribute a larger share of future growth. He also notes that China is uncorrelated to the United States, which is a benefit to portfolio risk. Lastly, VWO itself is geographically diversified. Brazil's Vale makes up 0.90% of the portfolio, Russia's Gazprom 0.46%, and India's Tata 0.46%, among others. True to Bogle's legacy of wanting to offer an easy way for people to own the market without losing a ton to management costs, Vanguard only charges a 0.10% fee on the fund. VWO also pays a 2.03% dividend yield. Dalio's third most owned stock is American retail giant Walmart. In fact, Bridgewater Associates increased his weight in Walmart to 4.30% of their holdings. Portfolio Insider projects their revenue to grow 6.72% this year. The Wall Street Journal reported that personal consumption was already back on track, in addition to earnings per share growth forecasted at 8.66%. Walmart also pays a dividend yield of 1.51%. Bridgewater's fourth most owned stock is Procter & Gamble, the consumer packaged goods behemoth. Through the first 3 months of 2021, the hedge fund increased their stake by 19%, and PG now makes up 3.84% of their portfolio. You might know them better by their brands like Tide, Bounty, Gillette, or Old Spice. Procter & Gamble has raised dividends 64 years in a row, and the dividend yield is now 2.45%. Leading Chinese e-commerce site Alibaba is Dalio's fifth largest position. Their record fine was part of China's crackdown that also included Tencent, Didi, and more. Shares are down more than 21% over the past year. Yet famous value investor Charlie Munger was tracked owning over 165,000 shares. Now might be a time to buy. Yes, even with founder Jack Ma gone, there's risk. But with Portfolio Insider analysts projecting sales to grow 52% this year, the company's 21.51 price to earnings looks reasonable when compared to the S&P 500 trading at a PE over 33. That's it for Ray Dalio. Hit the like button and subscribe if you enjoyed the video, and comment down below with which billionaire you want to see next.